All right, right on. What's up, guys?
How's it going?
It's going.
Ryan, Colin.
Everyone looking all dressed up for the Zoom meeting.
Yeah, I got dressed up for today.
Dude, I just got back from going out. I had a bandana.
There you go.
You know, proper PPE.
I just woke up. You can see.
You just woke up.
1:30 in the afternoon. I woke up.
There you go. Little power nap.
Yeah.
Yeah, no, man. I wanted to pull us together, let you, Colin, kind of go over some changes that you've seen in the lending industry on the commercial side of things. I know things change pretty much every hour, every day. So if you want to kind of give us some headliners.
Yeah, I'll kind of go through my experience. This is the first time I think I've updated you guys on commercial lending in general, is not just in the last couple of days or week, but even just in the last month or so. I think I touched on it with Mike for a little bit. This all kind of started out, when this was, interest rates became super low. This was just hey, there's something weird going on overseas, some virus rumor. The markets are a little bit, shaky right now. Interest rates are super good. I was doing 7-10-year fixed rates at 3%. I had one deal at 2.95. It was the first deal on the commercial side that I've ever done a deal that had a 2 in front of it, which was a big deal. Nice. So things were very good. We thought we were just getting, very low interest rates. Business was going to be very good. And then, the weeks went on, and, a couple weeks later, I had a retail strip center in Sacramento. We had a refinance going on for that. And it was done through a regional bank that's headquartered up in Seattle. And, this was when Seattle just started getting hit, but down here in Southern California, we were still, going to the beach, and every day was normal, and, interest rates were good. And they called and they said, hey, we got to cancel the loan. We're not doing any retail properties. And at that time, it was like, talking about, like, things are great, things are a little shaky. We had this, we have a little flu going around. What's the big problem? And they said, Colin, you don't understand. You guys in SoCal haven't been hit by this as drastically as we have yet. It is a ghost town up here. He says it is scary, it is apocalyptic, and we don't feel comfortable going outside, much less investing further into retail properties. So that was kind of the first kind of thing that really hit me personally, that was like, okay, we need to really, really kind of figure out what's going on and monitor how this is going to affect commercial lending going forward over the next couple of months. And as the weeks went by, like, sure everybody experienced, different things, but in our world, it just got worse and worse and more shaky and shaky as things obviously progress, and we've all experienced over the last month. We've gotten to a point, I'd say, just in the last week or so, where things, not stabilize isn't the right word, but people are starting to figure out what they're willing to and not willing to do. The last month or so was, quite honestly, the Wild West in commercial lending. Different lenders obviously they already have their different appetites and proclivities and, guidelines and everything else. So it affects each lender differently. So I would say overall, the last 3 weeks, it was really the Wild West. It was a shot in the dark for a lot of things, because nobody, as a broker, one of my main values is figuring out what everybody is doing and what they're willing to do. And it's hard to do when they don't even know what they're willing to do. You talk to two different people at the lender, and you get two different answers. And you talk to the chief credit officer, and he has one answer at 7 o'clock at night. And so many things are evolving in today's world that he'll have a different answer at 10 o'clock in the morning on what their policies are and how things have changed and how they feel about certain properties, and just changing daily and hourly. And it sounds a little dramatic, but it was absolutely true for the last 2 or 3 weeks. Things would literally change hourly on what lenders to do. So I've literally been stuck kind of ground zero here, front lines, on the phones, going through all of the deals that we had in progress, making sure those were secure, and if there was any changes. And a lot of them did change. A lot of them, some deals were canceled, some were changed very drastically. Purchases, buyers put things on hold, like everything's just kind of, in a waiting period till till we know what's going on. So I don't think anybody still knows what's going to happen and what they're willing to do, but probably in the last week or so, lenders have finally said, okay, we've hit, we're heading towards the peak of this virus. We're starting to see the effects of it. We've had our management meetings, our board member meetings, our president meetings. We've all discussed internally, at each lender, where our vulnerabilities are, where we want to head, what we're comfortable with. So just recently, lenders have finally started to say, hey, look, we're paused on lending for the next 3 months, come back to the end of the summer, and we just want to wait it out. We have the clout in the market to just not do business and just wait. We don't feel comfortable. Some are really on it, business as usual. And to the most part, that's a lot of the community banks that are very hungry for transactions.
Yeah.
And they're always fighting for transactions. So they're happy to pick up on, on those types of deals. I would say the majority of lenders right now, though, on the commercial side are kind of somewhere in the middle. It's like, we still want to do business. We still want to do loans. We still have to do loans, but we're going to be much more conservative. And I think that's where everybody is at right now. So particular property types like hotels, hospitality, mom and pop retail centers, lending on that is practically dead right now.
Yeah.
If the deal needs to get done, I mean, I'm sure something could be put together, but for 75% of those deals, they're just dead in the water. The remainder, multifamily, commercial, industrial, they are still alive, but much more conservative and across the board. So lenders are still doing deals, but that 75% loan is now going to max out at 65%, and the liquidity requirements for the borrowers doubled, and that non-recourse loan that you wanted is off the table. You have to sign personal guarantees, and the probably the more common and largest change is whether the lender thinks that this is going to go into a recession or if this is going to clear up in 3 or 4 months, and nobody knows what's going to happen. So the common thing that lenders are doing right now is adding in an interest reserve for the loan to basically pay themselves, because they don't know if tenants are going to be paying their rents, which means they don't know if the landlords are going to be able to make their mortgage payments. So yeah. I think the consensus with most lenders is, hey, we're going to be conservative across the board. We're still doing deals, but we're going to be conservative everywhere, and we're going to make sure that we maintain a 6 to 12 month interest reserve, because we're just going to assume that your tenants aren't going to pay rent and you're not going to get $1. And we need to be able to be comfortable that you're going to weather that storm and be able to make our payments. So that's kind of the new normal, is having that built-in interest reserve, and those aggressive deals where, hey, I want a 75% loan, the property's in a tertiary market, and I want a non-recourse deal. It may have been possible last month, with the right brokers and lenders, is just not around anymore. It has to be a very conservative deal to make it happen. So it's a funny thing. It's one of those, the rich get richer type situations, because the only deals that are getting done are for borrowers that have the wherewithal to weather the storm.
Yeah.
So they're the ones that are securing the refinances at 3.5%, 10-year fixed plus, and doing, and getting these deals done. And on the other side of things, for purchases, I'm getting a lot of my high net worth guys that have money to spend. It's like there's blood in the water. They're waiting for values to go down and opportunities to come up, and they're similarly going to be the ones that have the funds and the financing qualification to pick up on a lot of these opportunities that I think there's going to be. The other thing we're watching and still kind of keeping an eye on is appraisals. So again, just like it hits every lender differently, and they're going to have their own thoughts on what the hell is going to happen here?
Yeah.
Appraisers have the same type of mentality. So you get some appraisers that are going, hey, this is going to blow over. I'll come do the appraisal. I'm going to wear a mask. My personal opinion is that, this will blow over in a month or so. This isn't a big deal. We'll be back to normal. Your appraisal is not really affected at all. We're good to go. And which helps the financing too, because a lot of financing is based off of the appraisal.
Yep.
Then you have some appraisers that come out and it's, apocalyptic. This is the end of the world. Retail properties are going to drop by 40% over the next 6 months. We're underwriting to 15% vacancy factor, and it just kills the appraisal. It kills the financing. And the scary part about that is that there's no board to go off of that. It's appraiser to appraiser, and it's
speculation. No one just using their opinion.
Yeah, it's somewhat of an educated opinion. There's comps and everything behind it, and analysis, and so that's kind of the other thing. It's like, even if we get ahead of time and I go, all right, look, let's say I get yesterday, for example, I got a new client and it's purchasing an industrial property here in Southern California. And, we went through as detailed as I can be, as upfront as I can be, as good of a broker as I can be. We get it set up where, hey, here's, the new lending parameters. We're making sure that you meet these new, more conservative requirements. We've done our due diligence and provided, the client with, the most competitive loan options in the market, make sure they're getting the best rates and terms, most flexible conditions, and everything else that we provide. But at the end of the day, that is as diligent as I can be up front. I still have it in the back of my head, waiting for that appraisal to come back and hoping that this appraiser doesn't have an apocalyptic view of what's going to happen, because that could just kill everything. So we're just trying to figure it out. I would say, I know you guys deal a lot with triple net properties. So again, every deal across the board, very conservative. Hotel lending is dead. Construction is kind of on hold. Triple net properties are interesting because deals are still getting done. A lot of people that are, because in theory, triple net properties are probably the most liquid of real estate investments. You don't have to have a degree in commercial real estate investing to buy triple net properties, which is a big draw of why a lot of people like them, because they are an alternative asset class to going into the stock market and investing your money there. So that has driven a lot of people. I think we've gotten a lot of interest on financing for triple net properties because people see the market going crazy and they want to put it in real estate. Even if real estate is a little bit fluctuating right now, at least they can touch the building. At least they can put their hand on the collateral that they're purchasing, which I think is a big draw. So triple net financing is kind of up in the air right now too. I would say that the more desirable tenants right now are the essential tenants. So you get your CVS, Walgreens, your convenience stores, your drugstores, pharmacies, dollar stores, and if you are doing a fast food restaurant, making sure that it has a drive-through. Just kind of common sense stuff, as if this situation was going to last for the next 12 months. And what businesses are going to fare well. So, the sit-down Chili's restaurants, probably not going to get a lot of interest over a drive-through Wendy's or something like that. But at the same time, lenders know that, no matter what type of product it is, there's no promises right now. Nobody knows what's going to happen. So, you get this, I read an article the other day about, how popular Walgreens are right now and how they've, in this crisis, they've surged and gotten, so much activity, and grocery stores too. Then even in the last week, it's leveled out, and they're expected to have still, even with, the last month of a surge, they're still expected to have performance down, because at the end of the day, people went in and they did their rush shopping, they got their stockpiles, and now it's like, okay, I got my stockpile, and I'm going to go to the grocery store once every 2 weeks. My foot traffic's down, just everything crumbled. So it's going to be interesting. Again, lenders still need to get deals done. So just conservative across the board, and it's really deal by deal. So, I mean, I like to think I was valuable before as a commercial mortgage broker, but especially now, it is ever changing and evolving week by week, day by day. And half of my job is processing and kind of quarterbacking the loan process and just using my experience to and my relationships just to make sure that the deal goes smoothly and everybody is happy and it gets done. But the other half of my job is making sure that I'm on the front lines and I know what everybody is doing, willing to do, what their appetites are, what their hotspots are, what they're not going to do. And that is not something that is easily trackable. There's no spreadsheet for that. There's no list. There's no online resource that is going to change because it is ever evolving.
Yeah.
So I'm blessed enough right now to be still getting a pretty high volume of business. I would say things have changed. So the types of deals that we're doing are definitely different. So, I'm getting a lot more, I would say, rescue type loans, deals that because of everything that's going on have either fallen apart or changed drastically, and the buyer doesn't have the network or wherewithal to proceed. So we're doing a lot of rescue loans, a lot of bridge type financing to get everybody through this, and a lot more kind of, I would say, specialized lending. So more creative solutions. So not just, hey, I'm going to buy this retail strip center. I'm going to go into my Wells Fargo branch and talk to the guy up front and get a loan and everything will be easy peasy. Because now you have to look into lenders that are willing to do creative relationships and cross collateralization and more creative financing, for conditions and cash flow sweeps and trigger points and things that are going to mitigate the risk to make the lender feel comfortable with moving forward with the deal. And many lenders, they have their box. They have what they're willing to do, what they're not willing to do. Here's your 10 checklist items, meet all 10, and we'll maybe do the deal.
Yeah.
So my job right now is, I've been getting a lot of calls for that kind of expertise to arrange and structure loans that are going to make the lender feel comfortable with moving forward, doing forward rate locks to secure in what we know today versus what we don't know is going to happen months from now, and making sure to quarterback that process to make sure it closes smoothly, because you got people that are, have millions of dollars, hundreds of thousands of dollars in tax liability and 1031 exchanges and, different types of liabilities that they have. I got one guy that's under pressure to do a divorce buyout for his wife. And another guy that has a loan coming due with a private money lender when he bought it. And he thought this was going to be, oh yeah, I'll just buy it. I just want to purchase it all cash and make it an easy transaction. Financing is good. The market's good. Everything's, nice and pretty, and it was a 1-year loan and it's coming up in 2 months. And he waited too long, and now property value, debatably has gone down by 20%. And it was already a high leverage request. Rates aren't as good anymore. Lenders aren't as available. It's just not. He put himself into a potentially bad situation. We signed him up yesterday, and I think we're going to expedite things and get the job done for him. But just a lot of people are going to be in those situations. And everybody's going to have what's going on with this. So we're just trying to position ourselves here at HarborWest to kind of take on any new commercial loan clients and make sure that the people that are in transaction or have current properties with loans coming due and stuff, that they're taken care of, that they feel secure in their portfolio, and that they're they have a good deal, that they're not have a burden of having a loan coming due under the gun. And then on the flip side, for investors, like I said, there's going to be opportunities that come up because of this. People are dropping out of transactions. There's still good deals out there, but not a lot of people are or not as many people are going to be able to qualify. Things are a lot more shaky, and lenders are a lot more conservative. It is going to, it wasn't easy to get a loan before. Now it's really not going to be easy to get a loan without, some connections and some experience. So we're looking to bring that to investors and partner with them to make sure that they pick up on those opportunities that are are already starting to come up and are going to continue to come up, over the months.
Yeah.
All right.
What?
Let me ask you a couple questions. I didn't want to cut you off because you were flowing pretty good there.
Yeah.
Yeah, sorry about that. I told you, man, you get me going and it'll just go.
Yeah, I didn't want to cut in, but you're talking about the 1031 exchange. I know we just had a client who just ran out of time and didn't pull the trigger on anything. Do you see the IRS extending the timelines at all? Do you think that's going to happen?
I would imagine. I mean, your guess is as good as mine. I've been asked this question a couple of times. I would say eventually, yes. My understanding is that they've held back on doing that, but I can't imagine how you wouldn't do it in this day and age. With these months and all of the just unprecedented things that are going on. It's not a forgiveness. It's not like, I think that's the major difference that makes it more likely to happen than not, is that it is not a request for forgiveness. It's a request to extend the period so that the buyer can, adapt to what's going on. You know what I mean? And I think that's a fair assessment. So I would, if I was on a game show right now, I would bet that they're going to come around to it. But
I hope so.
Who knows?
I hope so. Because, for example, our client he's in his 70s. He's like, I can't, and he wanted to buy a multifamily. He said, I'm not leaving the house. I can't go look at a property. And I'm not going to buy anything I can't look at.
Oh yeah, absolutely.
Which seems fair to me, if you ask me. So hopefully something happens, it gets extended, and you can get back out there and find something.
Yeah, absolutely. We'll see.
And what are your thoughts on? Do you think owner financing may grow a little bit? Do you think that's for example,
owner user financing? Owner user financing is very interesting right now. So my experience with that so far, and that's good. That's actually something I didn't touch on because we were talking mostly about investment property financing.
Right.
So owner user financing for business owners and their commercial real estate properties. I've gotten a lot of calls on that as well. Some from past clients and some from people that have found me online or were referred to me, because a lot of people understandably don't understand kind of where the line is for what people do. They hear, because I only deal specifically with SBA loans that involve commercial real estate. So if you're buying a commercial real estate property, but you want to utilize the SBA program to buy that piece of real estate, that's something I can do. But there's a whole different department and a whole different world when you're just using SBA to finance equipment loans and working capital and everything else. So those are things I can't help on. And this new payment protection program and the various loans that the SBA is offering because of this. So I've been getting a lot of calls about that. And if you or the viewers aren't aware yet, they're all done through the bank. So any given bank is going to have an SBA department or a contact, and there's an approved list. So all those are done directly through the bank, and they are completely and ridiculously overwhelmed right now. I mean, the guys that used to, and it's kind of messed up because a lot of guys that works at banks are commission based, and they've been tasked with taking on these PPP loan requests to get the bank through their tough times and avoid foreclosures and bankruptcies and all these kinds of things that would ruin them. And so they're being tasked to handle all these. And the SBA, I mean, if you don't know, the big kind of delay right now is that the SBA and the banks can't agree on certain aspects of the buybacks and forgiveness and everything. So they don't even know, nothing's funded yet. Only applications have been accepted, but nothing's actually funded because they're still, I mean, besides processing them, they don't even know what the hell they're doing. So it's, so they're very overwhelmed with those requests. So on the commercial lending side, it's affected me because guys that used to get back to me in an hour are now getting back to me 2 days later. And, and that's just, everything's just so much more slow. So owner user financing, I would probably say is, out of all the asset types and deal types, is probably the safest right now, to be honest, because it can be more predictable. So when you have a multi-tenant retail center, with 5 or 6 different tenants, it's like, hey, well, I can guess how that Papa John's, pizza place or this chiropractor, how they're going to do, and you just kind of guess at it, and do
Right.
whatever as a lender makes you feel comfortable. But when you're working with an owner user loan, so if I get a guy in San Diego that manufactures jet ski parts, and he wants to, he has a $3 million industrial property down in San Diego, and he wants to refinance his SBA loan for $2 million, whatever it is. You can, as a lender, the qualification for owner user financing is based off of the P&Ls and tax returns of that company. Can that, at the end of the question is, at the end of the day, can that company support the mortgage payment that they're applying for? So that is something that a lender can control a little bit more than an investment property, because they can look at their past tax returns, they can look at their current year-to-date P&Ls up into a week ago, their accounts receivables, their accounts payables for, up until the last week. They can see what's going on, like not just last year, but right now. How is this coronavirus affecting their business specifically?
Yeah.
Right now, they can see the numbers, they can get the commentary from the business owners, they can walk into the business if it's more retail and see kind of the impact. Like, they can get their head wrapped around it a little bit better as an owner user deal than they can for an investment property. So there's that aspect. There's that aspect to it where it's easier to get done. The hard part is, again, the processing. There's so while in theory that would be the easiest to get done, it's also the hardest to get done right now, because those are the lenders that are dealing with the SBA PPP program, and you can't get a hold of anybody. You can't talk to anybody.
They're overwhelmed right now.
Yeah, they're overwhelmed. So if you can get a hold of the right lender and get them focused in processing the commercial mortgage request, then yeah, it's probably a deal that's more likely to get done. Rates are very good. In the middle of all this, we on Monday we secured a 10-year fixed deal for an owner user in Santa Fe Springs at 3.5%, which in my world is spectacular. So rates are still good for owner user deals. They're just harder to get done, and everything, like I said, across the board is more scrutinized. And they're definitely looking into kind of the business type it is. So, now there's a new requirement of, what does your business do? How is it affected by coronavirus? What is your plan to counteract the impact? What are your what about your employees, your payroll? Like, they dig in a little bit more just to better understand that owner user financing. But we're doing deals like the one I just discussed for Santa Fe Springs. We're getting opportunities on that because he needs cash out. His business isn't doing horrible, but he just realized, he called me and said, hey, this whole situation made me realize, I don't have too much reserves. I don't have too much liquidity. And it was my mistake. I don't feel comfortable right now. And I went to go apply for the PPP program. The website went down 3 times. I'm told that I might not have money for 4 or 5 months, and nobody knows what's going on, and I don't feel comfortable with that. So he approached me and said, hey, I'd like to get like $300,000-400,000 grand out of my property. My rate's 4.5, 4.75 right now. I'd be okay paying the interest on the cash out and getting it done quicker than waiting on this PPP program. If you can, give me a better deal, re-amortize, give me a lower rate on the $2 million that I owe already. And while we're at it, we'll pull some cash out and I'll feel more comfortable. And that's what we're doing for them. So, so we're still doing owner user deals, mostly cash outs, right? Small cash outs. Lenders are kind of
that sounds like he's not going to have a much higher payment, if a higher payment at all.
Yeah.
You're gonna get
So
his rate down.
exactly. So on that particular deal, to that exact point, we're pulling out. I want to say a little under $500,000 for him, but in lowering his rate, his payment's going to be about the same. He's going to get the money quicker, and it's going to be on a long-term mortgage, for him. And he's still going to apply for. He's still going to apply for the PPP program, and if he does get it, he's just going to pay down the loan. So in the meantime, in this unforeseen, PPP program, where he's applied for $500,000, he's come to us, we've lowered his rate, we're getting him the cash out in probably 40, 45 days, and he'll feel more secure and be able to utilize that quicker. And if and when, assumably, his PPP application goes through and is funded, whether it's next month or December, he'll be able to take that money and use it for working capital or pay down this loan. So we've structured in no prepayment penalty into his loan. So when that comes in, if it comes in, then he can pay down the loan. And so that way he would have only been paying interest on that $500,000 for a couple months or whatever it ends up being. So, yeah, just getting creative. On top of that, I would say industrial properties, as far as values, in my opinion, I think industrial properties are affected the least. In our Amazon, world we have now, warehousing, distribution, it's become more important, and it's only going to continue to grow. Southern California industrial vacancies are among the lowest in the nation. I think it's here and then like New York, New Jersey kind of area. But it is the demand for industrial real estate is so strong here, given our population and everything. I think that's the highest construction that's going on right now. So my point is that the demand is still high, and the coronavirus has only made companies like Amazon and other delivery services more popular. So the inherent value of those properties hasn't been affected. So on owner-user deals for industrial, we're not factoring in or modeling any type of change in anticipated value for those properties.
Do you guys see like any restrictions on regions or anything, like, with like New York being on lockdown and Illinois being really bad? Do you guys see any restrictions in doing any loans in those areas at all?
Yes and no. It's all it kind of has to be seen as, you have to take all the factors that go into it. So in general, I would say, as far as geographies, I would say no matter, even if certain areas are affected, more urban areas are affected than others, I would say just the level of being conservative across the board, it actually works the other way around. I think lenders are going to be more likely to be more conservative or cut funding in suburban areas or rural areas especially. So if they were already on the cusp about lending in rural areas before, now they're really on the cusp about lending there, or will not lend there at all. So rural lending is going to get extremely hard to do with a lot of the larger, more competitive lenders. But that's where the community banks come in. That's what I was saying at the very beginning, is those types of deals where, I could, I'm doing a deal in rural New Mexico, whatever it is, and I had my, big, strong Southern California life insurance company doing this deal, and they were going to, nationwide lender. Now they're not doing the deal, so that deal is going to go to a local Mexico community bank or credit union that is grateful to have the loan, and their rate might be a little bit higher, amortization might be a little bit lower, not as good of a deal overall, but the deal's still going to get done, and they're going to grow their little portfolio, and they're comfortable with it because the credit officer drives by the property every day, and he takes his kid to karate there, and it's more of a community bank type aspect. As far as the larger cities go, it's really going to be case by case. Honestly, it's going to come down to what type of property it is, where it is, how it's affected by the virus, and where is it projected to be going forward. So definitely a lot more scrutiny.
What do you think right now with lending guidelines is probably like the best triple net investments to look at? Like if you had a company came up and said, what's the best thing I could go buy right now based upon lender requirements, what do you feel would be?
If I had my choice of it, so That's tough. I would say the cookie cutter answer for that would be like the pharmacies, your CVS, your Walgreens, stuff like that. But the problem with that is, and maybe you guys have experienced this on the sales side more, but that's not a secret. People that are investing in triple net properties, they know that places like CVS and Walgreens are, the essential tenants that are open, and that's where they want to put their money. So even though in theory that might be the safer bet, everybody knows it. So you get, whereas you had 3 offers, now you have 12 offers, and the likeliness of those deals going through for your client, declines significantly, I'd imagine. So, I would say the golden thing would be to get tenants that are minimally affected right now, but would still be a good tenant and deal, 6 months from now when this is all over. So in my personal opinion, I would say the dollar stores are very good investments right now, because the dollar stores are open for business. They're doing well.
Yeah.
They're more recession proof because they're more catered towards low income. So they're going to do fairly well through all this. And then when this is all over, they're still going to do well. They're still projected to do well. They're just going to be great investments. And the other thing I like about it is there's a crap ton of them out there.
Yep.
So it's not like you have, these, New York investors, all fighting for the same Walgreens in Orange County, California. You're going to be able to get your client just as good, if not of a better, or probably definitely a better cap rate. And for a similarly producing tenant, but it's going to be a lot easier of a deal to get done. There's going to be less offers on those because there's so many of them. So I would say the dollar stores right now, if I had a client just come to me and say, hey, you choose what, I get for a fair cap rate and something that's going to be, smooth on the loan process, I would say go after the dollar stores. If you don't like what you see, then at least go after, a fast food restaurant that has, a strong franchisee, a strong sponsor, and a freaking drive-through.
Yeah.
And that would be probably option number 2, I would say.
So they're looking at what, about 35%, 40% down on those properties right now?
Yeah, I would say, I would say I'm hesitating because it's so, it is such a crapshoot, man. It's really case by case. I would say to be safe on things, I would just assume 40% down on everything.
Okay.
In general, compared to other investments, I would say you get lower loan to values on triple net properties because there's risk and reward. So to mitigate risk, a lender is going to lower their maximum loan to value, increase their equity requirement. You have a triple net property, you're relying on one single tenant. If they blow out, especially if it's very specialized, like a drive-through or something like that, it's going to take longer to release. There's more risk as opposed to a multi-tenant property. So in general, I tell people, this was even 3 months ago on triple net properties, I say, expect 35% down, maybe a little less, maybe 30 to 25 if it's a really strong borrower, it's a really strong property, and it has everything working for it, then yeah, we can get you that 25, 30% down. But rule of thumb, 35%. And in this particular market, I would assume 40% down on everything as you start looking at properties. So a lot of people, people engage me differently. They, engage me right up front and have me working along, by them. If it's a good client, I'll do it, or on a consulting type basis. But most people, what they do is, they run the properties by me. And it's like, hey, I'm pretty sure we're going to get this property. I have an LOI out on it. But before I put it into escrow, I just want you to take a look at it and make sure that we can get it done. So I would say the appropriate thing would probably be just assume 40% down on the property. And then when you get to a stage where you're about to be in escrow, then run it by me and we'll do our analysis and shop it a little bit just to confirm with some actual funding sources. And get a little, and kind of fine tune that quote before you get into escrow.
What do you think about interest rates on something kind of like that with 40% down based off of April 9th? I know this
Yeah,
might.
I can actually give you a very fair assessment because we just signed up a Panera Bread that has a drive-through. Panera Bread with a drive-through. I didn't know those existed. I guess we don't have them in SoCal, but I
I've
don't
never
know.
heard of that.
But it was a brand new construction Panera Bread with a drive-through in Green Bay, Wisconsin. They're buying it for 3.5 million. It's a 1031. He's going to put 2 million in. We're going to do a loan for about $1.5 million. So fairly good loan to value. Brand new construction, top, big MSA in Green Bay. So, and Panera Bread, it has a corporate guarantee. So Panera Bread functions good in general. There was some questions about, how it's going to fare over the next couple months, but it has a drive-through, so we're a little less concerned. We did a 10-year fixed deal for them at 3.95, 30-year amortization, full recourse, step-down prepay, 75 basis point fee. He'll pay for an appraisal, and we'll probably close. Our close date is, I think, May 25th anticipated, so about 45 days.
Okay. So, and I can add to what you're talking about with the whole triple net, the essential businesses. I keep an eye on a lot of those. I don't see them lowering their prices. What they're asking as far as, cap rate and sales price seem to be exactly the same as they've been doing. I don't see them discounting anything.
Yeah, well, we'll see as things go. What about units? What do you kind of see on the multifamily side of things in California?
So multifamily, I'd say is on kind of more of the safe, more of the safe side. So when I'm having my lenders go over, hey, what are you willing to do now given this current environment? What are you not willing to do? Most of the answers that you get are, we're not doing hotels, we're not doing retail. We are focused on multifamily and industrial property, multifamily, industrial, and select office and retail.
Yeah.
Is the answer. So I would say multifamily's probably been with industrial have been the least affected. For multifamily deals across the board, just a little bit more conservative. Cash flow ratios a little more conservative. Liquidity requirements, borrower strengths, just more conservative across the board. But I would say that's where a lot of lenders are actually focusing their efforts. That's where they feel the safest.
Yeah.
So we're getting there's a lot of liquidity in the markets right now for multifamily. That's what I'm getting lenders saying, hey, that's what we want to focus on. That's where we feel comfortable. Bring us those deals. We'll be really competitive. So the underwriting for those multifamily deals are a little bit harder. But when you get the actual deals, if you get a guy that qualifies and a property that qualifies, you're going to get a slamming deal. You're going to get long-term rates. You're going to get rates in the 3 to 3 3/4 range, depending on the program. Those are the deals that lenders are going to be fighting for right now, is the multifamily deals, especially in Southern California. There is still a question of who's paying the rent. So that's kind of been kind of the looming question for all lenders. In the last week or so, as April 1st came up, was how are tenants going to pay their rent? Are we going to get full rents, half rents?
No rent.
What are you doing with your tenants? Are you giving them any type of payment plan? What's going on with that?
Yeah.
And what I found is that the answers are across the board. I did a deal. We're doing a deal up in Fairfield, which is kind of North Bay area. And he says, no, my tenants are all, it was like a 12 unit. He said, no, my tenants are all, they all paid their April 1st rent. One guy said he'd be a couple days late, but pretty much business as usual. I had another multifamily in downtown LA earlier this week that said, we're, 2 of my 8 tenants have paid on time. The other 5, 5 of them said that, they'll be able to pay next month and ask me for some forbearance. And one guy said, I lost my job. I can't even pay for food. I don't know how I'm going to pay rent, and good luck trying to evict me. So it's
Yeah.
really across the board. So lenders that want to still do deals that, you know, kind of mitigate for this risk and not being able to babysit the property and the landlord and how they collect rents. Really, that just comes down to that's where those conservative measures come in. So, okay, we don't know, you know, April, May, June, we don't know who you're going to evict. We don't know who's going to pay partial payments. We can't babysit that. So we're just going to require 6 months of an interest reserve to make us feel comfortable, more equity, more liquidity, you know, more personal guarantors, cross collateralization, everything in the world to make us feel comfortable. But if you're okay with that, we'll give you a killer deal.
Gotcha.
Kind of the mindset.
Perfect. Now, you got any other
That makes
questions?
sense. I think we are good.
Yeah, it's gonna be ever evolving. I mean, this is kind of my recap for, you know, since this all started and then up until today, April 9th, and what's kind of going on this week in commercial lending. But it's going to change over the weeks, you know. So, you know, let's check in every week or two, kind of update, you know, you and your clients on everything that's going on, because they're, you know, lenders week by week, day by day, some are pausing, they're changing their requirements, they're, you know, saying, hey, you know, we actually need this in our bucket, so we're being really aggressive on this type. And it all revolves around how this virus impacts our world, which is changing daily. So it's going to be a very interesting couple months. You know, this is going to be our, I just got into commercial real estate when the Great Recession in 2008 happened, and I was just learning about the business at the time, so I wasn't really in the thick of things when it happened. But I would hear horror stories from, you know, older real estate guys, you know, that were in the thick of it. And this is kind of our thick of it moment, you know what I mean? So I think everybody's going to come out definitely stronger with a lot of war stories. But it's going to be just about, you know, moving forward, you know, because deals can't just stop. I mean, I think everybody pauses until they have a level of comfort.
Yeah.
But the world can't stop. The deals are still going to get done. 1031s need to get done. People need to purchase. People are going to want to invest as, you know, opportunities come up. Loans are still going to come due and need refinancing. Like, real estate lending is not going to stop. So it's really moving forward going to be about scope, networking, you know, getting creative, and really kind of utilizing brokers like myself that have specialization in this to navigate, you know, these crazy waters that we're about to go embark upon here. So, you know,
Hopefully
any of your clients?
These waters really soon too.
Say again?
Hopefully we get out of these waters quickly as well.
Yeah, and that's the other thing. So if it doesn't, I mean, I think right now it's, you know, the focus is on staying above water, rescuing loans that are coming due, making everybody feel comfortable in their portfolio, comfortable in their exchanges, and kind of focusing on just staying above water. And then when we hit the other side of this, whether that's, you know, a slow opening of our country over the next 12 months, or, you know, this disappears, you know, in 2 months when the weather heats up, or nobody knows what the hell is going to happen. You know, I think definitely, whether it's a strong recession, or even, you know, if we bounce back, no matter what the outcome is, there's going to be opportunities for investors at the end of this year, pretty substantial opportunities. So we're kind of positioning ourselves to have financing set up to take advantage of those opportunities, which for me means setting up programs that are high leverage, that are lenient to borrowers that may not be multi-millionaires, you know, that you know, are guys, you know, smart guys with good credit and, you know, stable financials, but, you know, don't have $3 million sitting in the bank, but they still want to take advantage of these opportunities. So we're kind of priming ourselves for that time.
Perfect. Well, hey, if you do see any massive changes that come during the week, hit us up and we could just jump on here and do a little quick update and push it out to everybody.
Yeah, definitely. We'll keep you updated on things. I have an email list, right? Right, update my clients monthly, but we want to do a little bit more further than that, I'm completely in. I think this is kind of valuable information to get out to all clients, because the sale and financing, people think of the financing kind of as a, get into transaction and figure it out later. Somebody will do my deal. And that's just not how it works. The sale, the contract, and the financing need to work and supplement each other perfectly in line to make a deal happen, because it will be a lot of times it's reliant on the financing. So, your clients, anybody, feel free to reach out to me to discuss anything. I love talking real estate, obviously. So, we'll take it deal by deal, week by week.
Perfect. We appreciate your time, Colin.
I get your newsletter, and it is really good, but again, it's scratches the surface a little bit, just gives you more questions sometimes. So it's good to be able to give you a call or talk to you and ask you specific questions.
Awesome. Cool. Well, anytime, guys. Thank you.
Awesome. Thanks.
Yeah.
All right.
Thanks, Colin. Have a good one.
You too.